Good morning. Welcome to Stock Market Today. It's Monday, February 1st, 2021. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So first day of February, hope everybody had a great weekend. Let's get back into it. U.S. equities much weaker on Friday and closed slightly above the session's lows. All sectors were lower on the day, and the major indexes saw a big weekly pullback. Energy, tech, industrials were your big outperformers, with the fan mag stocks much lower. Utes, healthcare, REITs held up the best. Treasuries were weaker, and that's kind of interesting. With the curve steepening, that's even more interesting. With the 10s getting back firmly above 1% after a temporary dip earlier in the week. Dollar saw some gains against the yen, but was mixed against the other majors. Gold was up 50 basis points, though. Posted its fifth monthly decline in the past 6 months. Crude oil settled down 30 basis points on the day. Now, as we get to the desk this morning, I know there was a lot of fear-mongering going on social media over the weekend, but futures are up. S&P futures are up 90 basis points after that sell-off last week. Asian equities were higher overnight. South Korea, Hong Kong, and Taiwan all up over 2%. And Japan, not quite 2%, but up more than 1.5%. European equities are seeing solid gains. Treasuries are bid slightly after falling last week. The dollar is up against the euro and slightly better against the yen. Gold up 60 bips, crude oil up 50 bips. So that's the framework as we get in. We're going to do our cross asset work on a Monday, as we always do. But first off, what I'd say about the equity markets is we are getting closer. We're no longer overbought. Remember, overbought, oversold is a construct for us within Chaikin Analytics using our proprietary indicator. We're no longer overbought. That's good. The indicator is moving down. That's good. Not quite at oversold yet. So it really becomes a function of how aggressive are you. But what I'm seeing is a pullback that's likely to produce oversold conditions above support levels. Now, I've been talking about that for 2 weeks. If you're unsure what that means at this point, and you've been listening to me for the past 2 weeks, it means that we want to calibrate our aggression levels probably to the more aggressive side, right? We remember what I said. We were overbought within the context of an uptrend. So you kind of calibrate your aggression level, i.e. make it less aggressive. You want to be super aggressive when you're overbought within an uptrend. However, when we get close to oversold within an uptrend and we're holding above key support levels, you probably want to get more aggressive. At least that's how I frame it up. Your risk management will keep you from getting into too much trouble. Let's say this is going to morph into something bigger, which nobody knows, right? I heard people talking over the weekend about how Robinhood could fail, and that would be a Lehman type event. Robinhood has 20 billion in assets under management. I'm not sure I can make that leap. Maybe I'm missing something, right? So I'm open to ideas, but I'm not sure I can make that leap just yet. So what if this did morph into something bigger? Well, I was listening to Dan, and Dan said we're oversold above support and we want to get more aggressive. Sure, yeah, of course. Probabilistically, that makes a ton of sense. But Dan doesn't have a crystal ball, and neither do you. And neither do these, doomsayers over the weekend. They don't have a crystal ball either. That's why risk management. If I'm wrong, your stop will take you out. You'll raise cash, and you won't be there for a move like that. Okay, I'll take that all day long. Support 360 to 370 for the SPY. We're testing the top end of that now. 360 realistically is the number that matters. 300 for the Qs, 190 to 200 for the IWM. The uptrend is innocent until proven guilty as far as I'm concerned. All right, so what happened last week? Equities come under pressure as we see hedge funds de-risk. But havens do not see much benefit. Dollar consolidates in a major downtrend. Commodities remain compelling. Futures point to a higher open here today. And I think it's interesting because everybody was looking for some sort of disaster over the weekend. Well, here you did get, I mean, look, we're down about 5% or so, 4% from the highs. Okay. Dow down 2% on Friday, 8 to 4 bulls to bears. S&P down a like amount. NASDAQ like amount. Power bar ratio still bullish. Small caps actually outperformed. So that's kind of interesting, right? Bonds down tick on a weekday for equities. Bonds down tick, small caps outperform. Does that sound like doomsday to you? It doesn't to me. Now, of course, it can morph. That's what I just said. But it doesn't sound like doomsday to me. I think what you have going on here is you have kind of a one-time phenomena where a savvy group of individual investors found an Achilles heel in a trade. And kudos to them. I think that is phenomenal. And they were able to inflict pain on some big hedge funds. And those hedge funds have now had to de-risk, right? I mean, one of the hedge funds in question I read over the weekend lost 53% in the month of January. 53% in 1 month. They need to be 100% for the rest of the year just to be even. So what does that mean, though? That means they have to de-risk and recalibrate. So what does that? That doesn't just mean they cover their shorts in GME and AMC. They sell their longs too. Look at some of the names that have been hit over the past few days. Starbucks, Nike, Apple, quality companies, that have gotten hit. To me, that's the opportunity when you calibrate your aggression level back to the upside. Havens didn't see much benefit. We've talked about it. Okay. So let's dive in. I don't think it's all doomsday. Stock of the day, VIPs, VIPS. A lot of the hedge funds that have been getting hit, actually their long books, fair amount of China exposure. I actually spent a big part of my weekend looking over the 13Fs of some of these big hedge funds because I'm kind of interested in the names that they own that are now going to be sold off, right? Number one, the other hedge fund vultures are going to front run them, right? And start selling. And then there's fear that these funds might have to liquidate. I'm not saying they do, but that's the fear, right? So people start selling the stocks they own. A lot of Chinese exposure in some of these funds. VIPs, not necessarily because it has exposure to these funds, but just because the setup looks interesting to me. Take a look at this setup here. Bullish stock, oversold, outperforming, bullish money flow, solid support at $26. As I'm calibrating my aggression level and thinking more about adding long ideas, VIPs looks compelling to me. Take a look at VIPS. Sector tracker now, movement of the last 5 days, major sectors. You can see the defense or everything down, right? So fine. Everything down. We get it. Defense outperforming, right? Okay, that makes sense. That makes a little sense in light of the de-risking that's going on, right? Especially if you had the beta trade on. If you had the beta trade on, you were long financials, discretionary materials, energy, industrials, right? That's what you're long in the beta trade. And if you believe, like I do, and that we're closer to the start of a cyclical bull, you are long the beta trade. Okay, so as the funds de-risk, that's what gets sold, right? And there's a rotation, or at least there's relative outperformance in the defensive areas. Let's see how things shake out. I do think this is a temporary phenomena. I do not think this is the top. Of course, I could be wrong, but probabilistically, I just don't see it. And we'll touch on why. Industry in focus, biotech, 23 to 30 bulls to bears, but it's outperformed by 25%. It's kind of an interesting, I always kind of take biotech with a grain of salt. I kind of look at biotech, especially early stage biotech. I'm not talking about, Regeneron, Gilead, like big companies with drugs on the market that they can be analyzed and looked at, sales growth, earnings. But biotech, the small, don't have any drugs on the market yet, complete science project. I have no edge there. And quite frankly, neither does our model, right? Because if there's no revenue, those early stage biotechs are always going to be kind of bearish at Chaikin Analytics, right? Because we have a fundamental model. And if there's no revenue, a lot of costs, of course that's going to be bearish. But so I like to think about biotech as a group. And and look at it at the ETF level, whether it's XBI or IBB or ARC's Genomics Fund, I almost view it as venture capital. You want to make a lot of bets, and a few of them are going to pan out. That's at least how I view it, because I don't have the bandwidth or the skill set to dig in on these kind of science project stories. So bullish, outperforming, moving towards an oversold condition as we consolidate within the context of an uptrend. That looks pretty interesting to me. Taking a look at what's trending now. Quite frankly, the movers and shakers from Friday, with the exception of BIIB, are almost all earnings related, right? Western Digital reported stock up 7%. Skyworks reported up 6%. BIIB, there was just some news around one of their drugs at the FDA, which sent that stock higher 5.5%. Hologic, HOLX, very bullish here at Shaken Analytics, up 5.2%. And DGX, no news there, up 4%. Taking a look at the loser side of the board, it's all earnings related with the exception of LNC. LNC caught a downgrade. So I'm not going to belabor the point here. You can see the moves. Understand that the top four on the loser side of the board were all earnings related movement, and LNC was a downgrade. Let's dive into it. So here's what's fascinating to me. The doomsdayers are out on the weekend. The doomsdayers love to come out. Right? And what's amazing to me about the doomsdayers is most of them have been doomsdayers for years, and the markets have just ground higher. Okay, now we'll argue that 2018 to 2020 was a bear market for most parts of the equity market globally. Okay, I'll give that to you. But I mean, I literally read a post from somebody who admitted to being bearish on equities since 2009 and wanted people to listen to him now as he was bearish on equities. 2009, folks, that's 12 years. 12 years this person's been bearish. We should listen to him now, though. Got it. Okay. Why don't we just listen to the markets and the trends and the facts, because those are facts. So as equities came under pressure last week, what did treasuries do? Kind of faded. And they've had a near-term pop, okay. But I don't know. I'm not compelled by this. Downtrend below the 200-day. What am I missing? I don't know. That's what's got me here. That's why I think that we're going to have an opportunity on the long side. Equities under pressure, hedge funds degrossing, de-risking. Yield curve still steepening, right? If you look at SHY versus TLT, now these are prices, right? So what do we have here? We have the short-term product outperforming the long-term product, right? What does that mean? That means the curve has to steepen. If these were yields, right, this is a proxy for the curve. If I thought there was real fear in the market, I would expect the curve to flatten. If I thought there was an issue, I think the curve would flatten, right? It's not happening. Silver over gold. Now, this has nothing to do. I am not advocating that, the new strategy seems to be to squeeze silver. There's this conspiracy theory that Wall Street banks are massively short silver, so let's squeeze the bad Wall Street banks. I have no idea. I don't play that game. What I'm watching here is silver and gold, right? Silver in the top, gold at the bottom. Gold's the haven, right? Silver is the beta in precious metals. Silver is the higher risk trade in precious metals, right? First off, if there was an issue with equities, I would expect a haven asset like gold to at least be able to get back above its 50-day moving average. No can do. Silver, on the other hand, is above its 50-day moving average. And quite frankly, silver is probably going to break out today. I don't know if it's going to break above 30, but it's certainly going to break above 28, 29. If that's the case, it's going to juice. And it's all over the news. The Wall Street bets crowd wants to squeeze silver. I don't know if they can. I really honestly don't that's not how I spend my time. I spend most of my time looking for solid investments within the themes that I've identified, but I do like commodities, right? So I am going to watch silver because I like commodities. I think we could be potentially at the start of a commodity super cycle. So I'll watch silver, but I don't know, not playing for the squeeze. It's not how I do things. Finally, the dollar, right? Dollar has tried to rally, but still below the 50, still below the 200. If there was an issue with equities, wouldn't the dollar be ripping? I'm told everybody's short dollars. I'll never figure it out. Have a great Monday, everyone. Take us for a test drive. I'll be back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.